Mark Zandi, Moody's Analytics, a chief economist, joining me now. And Mark, just give me your sense of this jobs report. I think initially, obviously, some sort of relief out there that it wasn't below the 150,000 mark. But there is some issue when you take a look at the fact that unemployment did rise just a bit. We take a look at labor force participation. So what was your biggest takeaway?
It was mostly down the strike zone, Seana. I mean, 150K, kind of sort of where average monthly job growth has been for a bit here. Enough jobs to keep unemployment close to that 4%. Not too many jobs that it would generate inflation worries or a higher interest rate. So kind of sort of down the strike zone, maybe on the softish side of where I thought it would be, but barely on the softest side. But it's one of those. There's a lot of clouds out there, some storms. Things are getting pretty dark. So I think I'd soak this number up. I think it might be the best number we get for a while.
Things are getting pretty dark. Mark, what does that look like?
Well, if we keep going down the trade war path, I do think we're going to see much weaker job numbers dead ahead. Depending on how things play out here, you can even start constructing some recession scenarios. I put the odds of a recession starting in the next 12 months at close to a third, which is up quite a bit from where I was just a couple, 3 months ago. And that goes right to the trade war that's unfolding. I had thought that, the president, after some back and forth on tariffs would, back away from them, and declare victory and move on. But it doesn't feel like that's happening. Obviously, I don't know how this is going to play out. There's just a boatload of uncertainty, and that's part of the problem. But it does feel more likely that the tariffs are going to be around for a lot longer. More countries are going to be involved, more products, more companies. And if that's the case, I do think it's going to be tough for the economy to digest that in the context of everything else that's going on with regard to economic policy. So I am growing more concerned about the economy's prospects.
Mark, is it the tariffs themselves, or is it the uncertainty that's been created by the administration that is the biggest threat to the economy?
Well, right now it's the uncertainty. Like, you're a business person. What do you do with this? I mean, the president said, okay, we'll take the tariffs off Canada and Mexico for another month. I think that's what he said. I mean, it was for those products that are under the USMCA, but there's a lot of products that aren't, but who knows? But that's the issue, the uncertainty. What do I do with this? It's the stroke of the pen risk, right? If something can be changed by the stroke of the pen, a business person is going to have a hard time making an investment decision based on that, or a hiring decision, or a layoff decision. So it feels like the economy already is struggling under the weight of that uncertainty. And then it's the tariffs themselves that are going to matter. If you raise tariffs by 25% on Canada and Mexico and 30%, now we have 30% tariffs on China, that's real money. That's a real tax that American consumers and businesses are going to pay. And they're going to have a problem with that. It's going to hit spending. And then all of those things are coming together and weighing on the equity market, the stock market, which you talk about a lot. And the stock market is central to the economy's performance because a lot of the spending that's being done is being done by the well-to-do, and they're focused on their stock portfolios like a laser beam. When stock prices are up, they feel good, they spend more. When stock prices are down, they spend less. That's a problem too. So I can go on and on and on, but all it adds up to a much weaker economy, even again, potentially on the scenarios, a recessionary economy down the road.
Mark, you just mentioned consumer spending, and we have a chart from Moody's, actually, just in terms of how reliant that consumer spending has been on that higher income, higher end consumer as of late. How big is this a massive red flag here for the economy?
Yeah, it's a matter of concern. The work we did showed that the folks in the top 10%, 20% of distribution count for the bulk of the spending that is being done. Folks in the rest of the distribution of income, the bottom 80% of the distribution, are kind of barely holding their own. They're spending, they're doing their thing, but it's the folks in the top 20%, the top 10% that are driving the train. And they're doing well on all fronts. They've got a job, wage growth is strong, they're getting bonuses. But the thing that's providing the juice, that's really powering their spending is their wealth. Their stock portfolios feel they're up. Housing values are up. If they have any debt at all, it's a 30-year fix. They locked in when rates were very low. So their balance sheets are really strong. But stocks are key to that. And if stock prices start heading south in a consistent way, and obviously we're now moving in that direction, that's going to knock the wind out of their spending. Not that they're going to cave and cut back, but they're just not going to be quite as aggressive. And because they're so key to all of it, that thing means the whole economy slows down. And by the way, Seana, the American consumer and the high-end consumer is the key to our economy. It's the key to the entire global economy. We're buying a lot of what's produced overseas as well. So it's really very important that that group continues to feel good about things and continues to spend.
Yeah, also illustrates the potential threat there just to the global economy, obviously just outside the U.S. as well. Mark, always great to talk to you. Thanks so much.
Sure thing.